So last week, the Reserve Bank Governor released the Reserve Bank's top-level forecast for the economy. And we were quite pleased that those numbers were very much in line with our own that we released 4 weeks ago. The first observation was that they expected the economy to contract by 10% in the first half of 2020. We're at 9.5%. Secondly, they expected that the unemployment rate would reach 10% at the end of June this year. Our forecast has been 9%. Over the year, they expected the economy would contract by 6%, and our forecast has been 5%. So we're very much in line with the official view with regard to the unemployment and growth outlook. But of course, our forecasts have been out there now for about 4 weeks. It was quite a daunting prospect at the time to have a blank piece of paper to try and work out exactly how that growth and unemployment profile would evolve. So we're pleased that the central bank has a somewhat similar view. Where we do differ is next year. We don't expect the economy to bounce back by more than about 4%, which will be above potential growth, but certainly nothing like the 6 to 7% that the Reserve Bank is expecting. The other major observation the Governor made was around the target for the 3-year bond rate. As you know, the Reserve Bank has a target of 0.25% for the 3-year bond rate, which is the same as the cash rate target of 0.25%. He indicated that he expected that bond rate target would be around for a couple of years. It's really significant that they've set the bond rate target at exactly the same level as the cash rate target, making it clear that they expect that cash rate target will remain for some time. And he also made the explanation that they didn't expect to raise the cash rate target before they moved the bond rate target. So does that mean that they have no flexibility with regard to the bond rate target? I think not. I think that as we move over the next few years and it becomes clear that the Reserve Bank will be raising rates within the subsequent 3-year window, it'll make some sense for them to raise that 3-year bond rate target, possibly to 0.35 to 0.4, which will make the market realise that there won't be a 3-year gap for the raising of the cash rate. And that'll provide the Reserve Bank with some additional flexibility in the way they're promulgating their policy. Our view is that the cash rate will remain at 0.25% until 2023 at the earliest. So we expect our formal forecast is that the cash rate will be at 0.25% in December 2023. After that, our forecasts tend to be more projections when we tend to look at the overall movement back towards some form of equilibrium. That 3-year bond rate is going to be also very important because I expect that over the course of the next year or so, there'll be a huge surge in movement from floating rate mortgages to fixed rate mortgages. As people realise that the chances of the Reserve Bank cutting rates are very, very low indeed. They've identified the 0.25% as the lower bound. And so the 3-year bond rate and 3-year interest rates will become very important for the Australian economy, and that's why I expect the Reserve Bank will want to maintain that target and move that target in line with how they expect policy to eventually evolve. Now, bear in mind there's been a big change in the way central banks are operating. Think about what happened after the global financial crisis. The last RBA rate cut was in April 2009, and yet by October 2009 they were actually raising rates. So only a 6-month gap between the last rate cut and the first rate hike. And that was very much around this concept of we have to be preemptive. We expect Australia to be benefiting from a mining boom. We expect that inflation pressures will start to build, so we need to get ahead of the curve. I think central banks have learnt that that's not the way they need to operate in this current environment. Inflation is very slow moving, so it's much more sensible to wait until you actually achieve your target before you start to move interest rates, because being preemptive can create the issues that we saw in that 2009 period where rates were pushed up very rapidly by 175 basis points over about a year, and then they peaked in 2011 and they've spent since 2011 from 4.75% coming all the way down to 0.25%, indicating that probably that move from 3% to 4.75% really wasn't that warranted. So what is going to determine interest rate policy? I think it's going to be all about the unemployment rate. Bear in mind the Reserve Bank expects that full employment is around 4.5%. We expect that the unemployment rate will reach about 7% by the end of this year, but hold above that 6% level through most of 2021, 2022 and 2023. We don't expect the economy to be able to grow much more above trend over that period. Bear in mind the weakness in the economy going into the COVID crisis, when the unemployment rate was holding around 5.1%, but economic growth was disappointing, and in particular wages growth was only running around 2.5%. We expect, with a high degree of spare capacity in the labour market, the unemployment rate remaining high, that's going to weigh on wages growth. Wages growth we expect to be only 1.5% by June next year, and will struggle to get back to that 2.5% over the course of the next few years, indicating there will be very, very limited pressures on inflation. For me, the really key issue is going to be around fiscal policy. Fiscal policy is doing an extraordinarily good job to protect the Australian economy against the virus, but we don't want to see fiscal policy go back to the stance that we saw prior to the virus, where governments were focused more on maintaining their AAA rating and achieving surplus, rather than using fiscal policy to boost growth in the economy. So my expectation is that policies will be adopted that will be much more pro-growth, will put the AAA target, or the maintenance of AAA, certainly as a secondary issue, and the restoration of growth and the restoration of lower unemployment will become the key target. Having said that, I expect that to be a necessary but not a sufficient condition to get unemployment back to that full employment level. And as I've indicated, we don't expect that unemployment rate to get much below 6% over the next few years, meaning that interest rates will remain on hold for that very, very long period. Thank you.